Hello, this is Shane from VsCap Capital. Today I just wanted to run through a very brief point on leveraged ETFs, which are becoming more and more popular, but one point which is extremely simple and straightforward and really common sense, but I thought it would be worth highlighting on a spreadsheet nonetheless, is doing the returns of a leveraged ETF versus a basic ETF. So a lot of people would say, well, it's just perhaps 2 times or 3 times the normal ETF if it's leveraged. Well, not exactly right. So looking at this example, we just have a hypothetical gold ETF which I've made up. We based it to 100, and we have a 15% return on the first day, 100 and a 15% increase on the rebase of 100 is 115. And oh look, we have the gold ETF, which is leveraged by 2 times. It's at 130. So that's absolutely brilliant. We have twice the amount of return. We've guessed it right, and we've done very well. But if we look at the 3 next periods, we have 15% return first period, minus 15% in the second period, and then up 4% in the final period. So on a normal stock or ETF or spot or whatever it might be, we end up with 1.66% as the final result, which is certainly reasonable. You'd be happy with 1.66. And then you'd say, well, pity I didn't invest in the leveraged gold ETF, I would have got twice that amount. Well, that's actually wrong. Completely wrong. Because the way leveraged ETFs work is that they follow this kind of pattern. So they take a 15% drop on 130 brings you to 91, and a 4% increase on 91 gives you 94.64. So the whole basics of this is that holding these leveraged ETFs give you a significant higher downside risk than the spot does. So after only 3 days, look at the difference. We have 1.66% increase, and lo and behold, it's a 5.5% decrease in the leveraged ETF. So not only is it a little bit off tracking twice the underlying ETF, but it's actually having a significant loss. So a lot of people don't realize this when they invest in ETFs. As I said, it's a very straightforward mathematical calculation. It's how leveraged ETFs work. And as I said, although it's very basic to look at, I thought it would be certainly worth highlighting this factor for anyone who isn't currently aware of it. But if you are going to be looking to get double leverage, then I would suggest not doing it in the leveraged ETF market, because it's a bit of a robbery, and on top of that, anything over 1 day holding period, you tend to get a big potential losses from this example I've shown here. So there seems to be a lot better ways to get exposure, be it in future markets or in the option markets, or even if you want to try and arrange something on an institutional basis, some structured products. If you're a big institution, you can probably arrange for a very attractive structured product to be delivered to you, which will give you much better exposure and be a lot cheaper and a lot less risk, and probably give you more return as well. Thank you for watching. Good luck trading ETFs, and good luck trading leveraged ETFs if you decide to do so.